for discussing corporate governance and the international profit shifting. The evidences from India, and as I understand and appreciate, this is based on your first-hand research, having perspectives from the international practices and how India has also been a party to it. If you allow me, I would like to reiterate again. I understand that some of the participants are regularly joining us in our programs, and especially the Power Talk series. We try to bring in interesting topics and the power speakers for discussing the issues which are of relevance to all those who are corporate governance professionals associated with public and private sector and are passionate to offer solutions to the various challenges in the interest of the nation, interest of the companies, focusing stakeholders at large. Today, the Power series which we are going to offer is third in number, and we have many more to come in the times to come. I would like to congratulate you all for sparing your valuable time and being with us, and I'm hoping for a successful event and engaging discussions. I welcome Professor Anis Sogatan again and would like to thank IIM Ahmedabad for having association with Independent Directors Data Bank IICA in organizing this event. So over to you, Professor Sogatan.
Thank you so much, Dr. Gupta, for that warm welcome and nice introduction. First of all, I would like to make sure that my screen is shared and it is available to all the participants, because I'll be using a presentation to run through the talk. If I could get a confirmation that my screen is visible.
Yeah, it's visible.
All right, so I'm just going to, full screen this, and I hope that the screen is now visible to all of you.
Perfect.
Yeah, perfect. So, you're right, and this is based on first-hand research. In fact, one of the earliest research which comes from India on this topic. So I'm quite glad that you provided this platform where we could share some of the findings, and I'm sure that many of the participants in the audience today would be curious. Some of them would be interested in as a matter of practice and would like to know more about international profit shifting and what is the status that we have about profit shifting from India. So, this is how I have broadly organized my talk. When I talk about international profit shifting, the word that has caught up in the practice world is what we call BEPS, or base erosion and profit shifting. This is now it's been around some time, close to less than a decade. I guess OECD was the first body to kind of coin this term, base erosion, profit shifting, and they have been making concerted effort, OECD level, G20 level, to bring about international cooperation among the countries, among the various tax jurisdictions, to ensure that profit shifting really doesn't happen. So what exactly is profit shifting? People who are aware of it from the world of practice, I'm basically referring to BEPS, base erosion and profit shifting. So what is the phenomena? We know that international corporations and companies which operate across the globe, where their operations are spread across multiple tax jurisdictions, it is a rational choice as a corporation to see if they can optimize their overall tax liability, right? So as from a corporation's perspective, what they're trying to do is they're trying to optimize their overall tax liability because they operate internationally, right? So they could, the way in which income is recognized, the way in which expenditures are moved around, it is possible to minimize their overall tax incidence. And what has been observed since the 2000s, in fact, it's been there for quite some time, 60s and 70s. Since that time, it is existing. But since to around last 2 decades, the quantum of this activity has increased substantially. In fact, some of the very well-known corporations, some very large companies, they've been, running operations to the tune of several billion US dollars across globally, but their overall tax liability is close to nil, and that that sort of has prompted many regulators and many governments across the globe, especially from countries who have been at the losing end, to investigate this a little bit more and see what are the reasons behind it. There is an estimated 100 to 200 billion US dollar, about 5 to 10% of the total income tax revenue that is hidden. It is moved around in clever ways so that tax is completely avoided. Now this has multiple repercussions. Obviously there is a direct linkage to what we call your compliance in your home country, but you also have a corporate governance issue. So, and that is where I would like to highlight. I'm sort of using profit shifting as a mechanism to see how corporate governance and the quality of institutions of the country, the macroeconomic institutions, how these two combine together to influence the extent to which companies engage into this practice, right? So that's the broad, context. I'm sure all the esteemed participants in the webinar would be aware of it. The most recent being the Panama Papers scandal. People started talking about it again very recently when the Panama Papers from the Mossack Fonseca documents were leaked. In fact, if you look at the extent of Panama paper leaks, the companies incorporated are mostly, if you look at the name of the companies, most of them are tax havens, countries where the tax rates, the corporate tax rates are extremely low, and the countries which are painted red in the globe represent the home countries of the companies which got figured out in this paper. So there is kind of global representation. We also heard a bunch of Indian celebrity names coming up in this list, and it's broadly in the same context that this talk is about. How profit shifting happens and all. So let me set now that I've set the tone, let me be more specific. What I'm going to talk about today, and this may be useful to you as people who are in practice. When we started looking at this problem of tax shifting as part of my dissertation, doctoral dissertation, when I was at IIM Bangalore, we started investigating this more carefully. And one of the objectives of this investigation was to see, is it possible for us to, one, estimate the extent of this activity happening in India? Second, can we find out the forces that are facilitating and the forces that could control this? So that was the primary objective. And let me just show you this article which we published 5 years back, and this is a short summary of the findings. And one of the outcomes of this study was that based on the framework that we developed, we could actually make some recommendations. So obviously, tax profit shifting happens when there is a tax difference, right? If the tax in the country is reduced, the incentives to engage in profit shifting goes down. There won't be any profit shifting. So it's essentially a tax competition which is happening at international level. Certain countries, by reducing their corporate tax, are able to attract investments or incorporation of companies in their countries, in their jurisdictions. So if you imagine a world in which all the countries have same tax, if somehow magically if that happens, then there is no incentive for anybody to do any kind of profit shifting, right? The counterfactual, the other way to ask this question is how low the corporate tax rates should be so that the incentives completely vanish for India. And our calculation was that it should be around 25%, right? obviously tax rates are decided by various other factors, including, the fiscal budget and everything else. But if you only consider the incentives to shift profit shifting across the world, we conjectured and we sort of made a claim that if you reduce the corporate tax to 25%, and on an average, the companies will not have any incentives to shift profits anymore, right? So this was a finding. So let me just walk you through how did we arrive at this number, and I think that is more interesting to the participants. What was the formula that we used? What were the logic analysis that we used to arrive at this number? And can we recompute it, right? Because it depends upon the current state of tax rates, right? If everyone starts reducing, this 25% will also have to go down. If everyone starts increasing, actually we can also increase the tax rates and there won't be any shifting. So this is one of the core pillars of the talk that I will be focusing on. How did we sort of arrive at this 25%? And in that process, I hope that we will also be able to have some conversation around what are the corporate governance angle to look at it, what is the macroeconomic institutional governance angle to look at profit shifting, right? So the primary research, which it's published 2015, is published in this Journal of International Business Studies, and we'll be deriving. I will not be going through the article. It's quite technical with a lot of numbers, regressions, and everything else. But I will distill out the key summary of this research, and I'll present it to you in a way in which it is easy to understand, easy to comprehend. But for those who are academically inclined, who want to sort of go through the details of what was done, this is the primary reference. You can check this paper. You will get all the details about how it was done. Right. Now, even before the Panama Papers and all came up, international tax shifting was actually hitting the headlines, right? This is February 2013. In fact, this is the time when we started looking at, we designed the study and we conducted the study in India in 2000, when economists ran a cover about missing 20 trillion across the globe, right? And where is it going? And so we thought, people have done a lot of studies in the US and European countries. However, there are no good studies which look at microeconomic data or firm level data to make some estimates. There are no good formulas that exist. There are aggregate numbers which comes from macroeconomic balancing of trade flows, but that doesn't come with that kind of accuracy when you want to pin down on specific sectors, specific companies, specific governance practices that is leading to this. So that's the kind of broad context. And if you look at the quantum of the total volume, it's quite staggering. And what is surprising is some of the most well-respected, well-known companies in the world, they engage in tax shifting or what we call tax optimization practices. And you have Apple and Pfizer and Microsoft and all these corporations. They have several millions of dollars, apparently several billions of dollars of tax which is held offshore, and it is they pretty much pay very little. Now, if you look at this is a small list, but if you look at, there is something specific, something interesting about the sector in which these companies operate. Most of their value or most of their revenues are actually by selling products and services which has a lot of embedded intellectual property in it, right? They are in the business of trading intellectual property, right? It's an intangible asset which they are involved in trading. It's not like selling steel and minerals and so on and so forth. And it is precisely because of the nature of their operations, it is easy to move around and create structures with intangible assets, especially with royalty and patents ownership. And you can come up with these structures which enables you to do this massive shifting. Right. So the one, it's not a new phenomenon. It's been there A lot of companies are engaging in this. And this is an estimate of the extent to which tax avoidance has happened. US leads with around $200 billion. India is not really far behind. Around $40 billion of exchequer's tax revenues are lost because of tax avoidance. So that's the context I wanted to talk about. Now, who are the countries, right, which are sort of profiting from this? If some countries are losing tax revenue, some other countries are actually benefiting. It's kind of a tax competition which is driving this whole phenomena. And on the y-axis, you have pre-tax profit as a percentage of wage of the US multinationals, and you'll see that more than half of the foreign profits of US multinationals, they are actually booked in these tax havens. This is 2016, and most of them are tax havens, right? And this is the effective tax rate, right? So India is around 33-35%, and these are all the tax havens where the effective tax rate is 10% or less, right? And half of the profits are booked in these countries, and so these are the countries which kind of benefit the losses which are happening in partly in the other countries, right? This is another way to look at the same data. So I will skip that. Yeah, some of the biggest, again, same data. Companies, countries like Cayman Islands is on the very top. United Kingdom is not because of their own tax rates. If you look at the tax rates, UK is around 25-27%, but it's not because of their, but because London is the financial capital of the world, and a lot of these structures. Corporate structures get designed and formulated in London, and then that kind of becomes like a major junction for routing of capital, right? That's why they also figure. But all these countries are major recipients or facilitators of sort of tax abuse. So what are we talking about? In total international corporate shifting, pretty huge, 800 billion per year. I mean, that's a huge amount of outflow. Now, what is the source? About 50, more than half of it is because of trade mispricing. So a lot of transactions which happens between the companies of both goods and services, they are not happening at market prices, right? So there is inflation of pricing within the company, and that's one of the major mechanisms through which profits gets shifted. And MNEs, specifically in multinational corporations, because of the very nature of their operations, their operations are spread across. They have by design, they have a tendency to engage in this. Now, it's actually a tricky question to ask if it's like illegal or legal. Actually, there are two parts to this. Tax avoidance is it's something which companies do, and that is this clever structuring, and they reduce their overall tax liability. The other is tax evasion, which is basically suppression of information, which is an illegal part. Now, when we talk about profit shifting, actually it's a combination of both happens. But a lot of that is happening is actually legal tax avoidance. They're not illegal, but many of them, most structures are legal tax avoidance structures. And therefore it is of importance to know as a regulator what is it that is causing this thing, right? And if I as a country am losing tax revenues, it is important that I take some steps towards containing this. Second, if let's say I am a shareholder, I'm a shareholder in a company which is engaging in tax avoidance, right? As a shareholder, I might benefit because the companies they're actually optimizing taxes. But if you in a way better for the shareholders, at least in some sense. But if you look at carefully the structure of the ownership structure, the network of ownership structure, you'll realize that not every shareholder of every company in the network will benefit. And why? Because the term base erosion is there. Profit shifting happens by showing lower profits in the home country. So if I am waiting for like a dividend income, or if I'm waiting for appreciation in my share because of increased profits, that's not going to happen to me. So as a shareholder also, I might lose in some of these if I'm investing in some of these companies. So that's where the corporate governance angle comes up more strongly. And then there is a compliance angle. How does so both these issues are there. Let me give you two examples of how it is done. This is a case of Microsoft and Puerto Rico. Puerto Rico is again a U.S. Jurisdiction region, but then with different tax rates. So the tax rates in the U.S. is around 35%. So one of the primary means by which many tech companies engage in tax shifting is through a mechanism of royalty ownership and payment, right? So a lot of, if there is, so the way it is done, this is a simplified version, but you get to know the details if you investigate further. If I incorporate, let's say, a Puerto Rican entity, and I give all the royalties, right? I give the ownership right of the royalty to this entity, right? And all the sales are happening, let's say, in the United States. After the sales are, after the sales happen, in my expense account, I book huge payments as royalty payments, right, to my Puerto Rican parent who owns all the intellectual property rights. So because I'm paying all the payments, all the royalty payments, my profits, which I will show in the United States, would be very less, right? So I'll show very less profits in the United States and the high tax rate. So I'll pay less taxes here, right? So all this income will be recognized in low tax jurisdiction, let's say like Puerto Rico, and in effect I would end up saving a lot of taxes. So that's the broad design, right? That's the broad design of how tax havens operate. There are variations to this. There are different mechanisms out there. In fact, there are specialist companies like Mosaic Fosenka and others who help facilitate, design this kind of structures, legal structures, and this is how the Apple's tax haven, or tax optimization network works. You have a U.S. company, the Apple U.S. corporation. They transfer their intellectual property, the same modus operandi. They transfer their intellectual property, patent rights, and so on and so forth to a Bermuda-based company, right? But again, a tax haven. And this company, in turn, it completely owns another Irish company, and then there is the sub-licensing of royalties and recognition of revenues happening elsewhere, right? So through this clever, transition of royalty ownership to lower tax havens, the total taxable income which is declared in the home country is very less. And because there is less taxable income, there is very less tax to be paid. And if you look at overall, the total tax based on is much less. And if you look at the whole thing, it is pretty legal. There is nothing. Nobody is kind of avoiding paying taxes. Everyone is being compliant. But then there exists this very clever structure which enables some companies to avoid taxes, right? So these are the two mechanisms I just mentioned. There are variations to this, but I believe the participants in the webinar, they're getting a sense of the broad modus operandi that exists. In some cases, instead of royalty payments, royalty payments, how it goes out, there are intercompany loans paid at where the interest rates are higher than market rates, right? And therefore, the cost of the cost of capital part, which is tax deductible, that gets transferred back to a low tax jurisdiction where it is not recognized, and then that's another way in which tax is saved. Right now, this is like, it's not just an international phenomena. Within the countries also there are, the variations in tax jurisdictions. In fact, this building that you see, it's a building in Delaware in the state of Delaware in USA. This is 129 Willington, Delaware, and this building, right? This building alone is the legal address of more than 285,000 businesses in US. Right? This is the headquarters of 285,000 businesses. Why? Because these companies exist only on paper, and there are law firms which help you incorporate and then meet all the legal compliance of incorporation in the state of Delaware. So within United States itself, like Puerto Rico is one jurisdiction. You have Delaware, Nevada, all these within states, differences also are exploited by companies too. Closest to India would be Mauritius, for example. If you look at Mauritius, there are many such buildings where companies are operating, whose headquarters are operating, and many of the companies which have operations in India, they have a linkage in Mauritius, and if there is a Mauritius linkage, there is a potential for some kind of a tax, shady tax transaction business. So now, how is this corporate governance and macroeconomic governance influence? So from this context, let me dive into the specifics of how did we do the study and how did we arrive at this 25% number. Let me just quickly take a pause here. Let's see if is it so, Dr. Gupta, is it good that I continue my talk, or you want to pause in between, take some questions? How are you sort of planning this? Is it good if I finish this talk and then we'll keep the... All right, you know what, let me continue. In fact, if you have questions, you can always type it out in the chat box and see if I can respond to that. So let me just go back to let me go back to the talk. Right. So what is the linkage between corporate governance and profit shifting in general, and how did we arrive at that 25%? That is what I wanted to convey in this meeting. So let's start with something called ownership structure or the ownership network. What you see on screen is actually the network of companies owned by Louis Vuitton, the global luxury brand Louis Vuitton. And these companies, I mean, look at the brands, right? And you may be surprised that Fab India, which I always used to think is like a homegrown brand, has a Louis Vuitton connection, right? PVR has a Louis Vuitton connection, right? Cinemax, many Indian brands that we are known, are one way or the other linked to Louis Vuitton. It's like a single holding company with multiple, ownership structure. So where am I going with this? This is important. In fact, many companies, like they are incorporated. Companies don't really operate in isolation. If you look at your own company's ownership structure, you will know that there exists a network of cross ownership, right? Company A owns part of B, and which kind of creates a sort of an indirect control mechanism, right? And that is something core to a corporate governance angle to profit shifting. I mean, if you look at Tata's group structure, if you'll see there is Tata Sun, which is a holding company, and then you have multiple Tata entities which are held under the with the Tatas, and if you see that some of these companies cross-hold each other. In fact, this is the 2005 ownership, and this keeps changing. I mean, it looks like it's a complex network. Company A owns company B owns company C, and in that process, what happens is that directly or indirectly, the holding company can exercise control on their network of companies, the group's companies, right? And this is not new in India. I mean, this is look at this is Samsung ownership structure. In fact, the group structure or networked ownership structure is something widely prevalent across the world, more so in the Asian, European countries, far less in the Anglo-Saxon or rather the US and UK context. It's slightly different, but otherwise this is a norm. This is how most companies are there. If you are curious, you just go and check the ownership structure of your own company. Many of you may be aware of it, but many of you will be surprised to see the complexity of the network, which sort of run backwards. Now, what does this mean? What does it mean as a concept of corporate governance, right? So you're talking about ownership, and if I look at firm, any given company as a bundle of this contract, you see there are like two. This kind of divides you into two or three major parts. One is the controlling owner or a principal, right? So it shows that not all owners of the company are equal citizens when you look at them as shareholders. So not all shareholders are equal citizens of this company. There are the controlling family or whichever is the holding company, because of their block holding and because of this ownership structure, they are able to exercise a disproportionately greater amount of control. So they wield greater control on the entire network, right? Then let's say if I go to BSE, NSE, or I purchase some shares, I'll be part of this diffused other owners, right? I'm also an owner, a small part owner, but I'm a diffused owner. I really cannot control the business or influence the way in which the business is run as much as the block holder can. Then there will be other dominant principles. Mostly these are institutional owners. There could be banks who might be lending. There could be private equity that might be lending. And because of the size of their investments, even though they are not the controlling owners, but they can influence the way in which the company operates, right, in a more substantive way. So, and all these, the point that I would like to drive is that first, there are multiple class of owners. This is a simplistic view, and all of them, all these ownerships, all these owners or principals, they have divergent interest, right? The controlling family may want to do something else. The private equity investor or the debt holder may want to do something else, and I, as a small holder, the retail holder of the company share, they want something else, right? All of us have different expectations from this firm, and that is a core issue in corporate governance. How the company is governed so that all the expectations are at least met or nobody is shortchanged. In fact, it's anybody's guess that it is the diffused owner or the retail owners who mostly get shortchanged, partly because they don't have a direct kind of control. So let me skip this part on the. Yeah, I think this is more useful. Right. So now let's go back to this question, which I asked in the beginning. Like, what are the forces that leads to this, profit shifting? So I'm going to talk about two class of problems. One is the forces which is there because of the institutional structure of the country, right? The kind of legal institutions there, the kind of capital market development in that institution, and in general political stability of those countries, right? So the country level institutions, they can influence profit shifting. The second would be the corporate governance, how the quality of governance of the company itself can influence corporate policy, corporate profit shifting. So let me go to the country level factors. What our study finds that both the home countries, institutions and the host countries institutions, they both actually matter when it comes to profit shifting. It's not that one country having a higher tax would automatically lead to profit shifting. You also need another country with low tax, but then having low tax itself is not enough. Right? Not every country can become a tax haven overnight by reducing their corporate tax rates. It's not going to happen. And that was one of the key findings of the paper that we did, that not just low tax, you also need good institutions in place, right? You want to assure the investor that all the money that you have shifted from your home country, it is safe here. And that's precisely why countries like Switzerland, Cayman Islands, are tax havens, because they not only assure low taxes, but they also assure safety of the capital. Second, they also assure low transaction costs. There are companies, law firms like Mossack Fonseca and many others who help you structure this, right? So both these, the macro institutions in home and host both matters. Right. So as I said, the property rights, right? How strong are the property rights? By property rights, I mean, if I put my money there, I mean, would somebody else take it over, right? So how safe is my money? So that's how strong are these property rights? The institutions of contracting, what kind of law firms exist? What is the transaction cost for me to structure this kind of a thing? That matters. And the third is in what we call, monitoring of public bad. If let's say, the freedom of association, free media, and all that also affect the extent of profit shifting. So broadly, we are looking at two forces: the rule of law in the country, and the voice and accountability of institutions in that country. So I'll just tell you how this operates in the right. So I'll skip this part and I'll focus on the. This is a broad conceptual model which we use to estimate the numbers. Okay, so let's say there is a company. So in India, what we did is we looked at all the companies. We looked at all the companies listed in CIME, the Center for Monitoring of Indian Economy. They have a database called Provis, and in Provis they have detailed information about shareholding patterns, including the identity of large shareholders. Right. So we went. We have in our sample more than around 10,000, 15,000 odd companies. We looked at their corporate addresses of the large shareholders, and we checked if one of them is in which country they are sort of the home countries of all the big shareholders, and that was the key design, right? And then we looked at the quality of institutions in those countries and the quality of institutions in India. And and this is what we conjectured, right? So if there is a foreign ownership, let's say you have an Indian company, and now you open up the network of ownership, and you try to locate how many of them are foreign owners, right? And how many of them are in tax havens, right? Then we are conjecturing that it is likely, right, that if there is a tax haven owner, there is likely that the company will shift profits out. Because why would somebody have a Mauritius or a Cayman Island parent other than tax optimizing, right? So that is the primary conjecture, and we also conjectured, like I said, that in that host country, if the property rights are strong, right, it will increase the flow, right? Because investors or the corporate owners will feel comfortable sending their money to, let's say, Switzerland than to a third world country with very low tax. They will not do that, right? But in the same countries, if monitoring and transparency is very high, it will suppress, because there is a likelihood, think of the Panama case. Because it was exposed, it brought in a lot of ill will and bad equity to many of the companies and names involved. So they will be careful that if transparency is very high, it's likely that it will also bring down. So on the bottom side, we conjecture this is how the country level or macroeconomic institutions would influence profit shifting. On the top, if we see that if there is a dominant principles, let's say there is a foreign institution investor investing in the same company, if there is a big bank holding in the same company, it will all reduce, right? But if the company has predominantly retail investors, totally diffuse participants, there's nobody to stop a major blockholder from deciding to do what they want to do. So in that case, it will increase. So this is the framework which we tested using data. This is broadly the idea that there is likely to be profit shifting, and the amount will be controlled by these dials, right? If there are good property rights, it will increase. If there is high transparency, good media, it will reduce. Obviously, the tax difference increases, shifting also increases, and if there is good corporate governance, shifting would reduce. So these are the four forces, and we actually measure it. So that's the good, the interesting part. We looked at this data set of about 23,000 firm year observations, and this is from India. And you see these are all the countries in which you have the home, there is a parent. So look at Mauritius. Mauritius, there are a lot of companies in India where Mauritius, which are incorporated in Mauritius, or they have a parent in Mauritius. Similarly, you have United Kingdom and Germany. Many of them are genuinely doing business for business reasons. It is done. Now, I'll skip this and let me go back to the what we basically find. What we basically find is that the difference in taxes. So let's say this is the high tax country, let's say India, and this is the low tax country, let's say Switzerland, right? So this region shows, this if I draw a straight line, then that line will represent same tax rates per country, right? Now, the major finding of this thing of the study was that a tax difference is not good enough, right? You have to have a substantially higher tax difference for somebody to actually take up all the pains to do this shifting. So from this model, we basically derived, we did some small mathematical modeling, and we derived this following formula, that the amount of tax which a country like India can charge is a factor of two things. One, what is the quality of infrastructure, governance infrastructure at the macro level, right? Because the stronger, let's say, the macro institutions are, it is more costly for somebody to engage in this. So that plus the corporate governance, if the company is strong, there is a strong corporate governance, it also increases the cost of doing this, and multiplied by the the tax rate. If it's a low tax rate, then you can actually charge. You cannot charge much. So this basically translates to something like the maximum that you can charge has to be less than the governance infrastructure cost. And based on the data that I showed, we estimated these costs. And for India, it turns out to be the Tmax is 0.25 plus 0.75 f. So you see that the very broadly what this number means, that in terms of oversight on a company's operations, 3/4 of it is coming from corporate governance. Other entities who are looking at the operations to make sure that they are taking care of their own interests, banks, FIIs, and others. And then about 1/4 of it is because of how good our institutions are, how good the regulators are, how good the tax agencies are, and so on and so forth. So if this were to be zero, right, if there is no sort of zero tax, then if the foreign tax is zero, then at most you can charge 25%. And that's the sort of the story behind this paper, where we recommended that this is kind of the upper bound beyond which there will be some incentives because of both these factors, the infrastructure, the governance, macro infrastructure, and the corporate governance structure. Now, this was estimated in 2015, right? And we can do this, again in 2020. You will get different numbers, and that is an exercise, something which we need to do. And you will see that again, this was done for India, and we split up this cost, and we found out specific quantum of how much is like corporate governance, how much is the transparency index, how much is the governance effectiveness, and political stability and violence, how much of this is actually impacting. And then we sort of made an average across the countries, and you will see that in countries like these are all the tax havens to the right. The ones which are with a star are all tax havens to this extreme right, and all of them show very high profit shifting. On the y-axis you see the impact on profit shifting. All of them show very high profit shifting, and primarily because the home country, political stable countries, Singapore, Switzerland, Denmark, Mauritius, there is political stability, and you also have property rights are secured, right? So that's the core finding from this paper. So with this, let me just close the sharing and get back to this this model itself. So let me take a pause. So that's the broad idea of the study. We sort of made an actual estimate of the extent, and I think to the best of our knowledge, this is the most recent estimates using firm level data. This extensive data that we managed to collect to make an estimate. Not only that, the framework allows you to do multiple things. You can ask counterfactual questions, policy questions. What is a good tax rate, right? Which institution is contributing to what extent in profit shifting, and things like that. So let me now sort of stop the talk, and I'm open to questions, and I would leave it to the moderators from IICA to take over. Thank you once again, all of you. If you have questions, you can please I can take them. Yeah. Thank you so much.
I would request Dr. Gupta if you can take up the questions.
Yeah, we can allow participants to ask questions. They can raise questions if they have.
I will request Sri Sanjay Kulkarni, if you can raise your question, I will put you on mute. So please, Sanjay Kulkarni, please.
Thanks, Chris. My question is that, when many of the governments have double taxation agreements with many of these countries which have, like Mauritius and Singapore and other places. So governments, when they've made these agreements, clearly understand that there will be profits will be shifted from one place to another. And there is, of course, a benefit in return which is available. For example, from Mauritius, a lot of investment which flowed into India, which otherwise would not have flowed. The focus of the talk, Professor, seems to be that there is shifting of profit, but the benefit of the investment which generated that profit in the country in which it was invested could probably have also been considered.
Thank you, Mr. Sanjay, for asking this question. I think it's a very important point, right? The talk is kind of silent on that aspect. What about the flow of capital? But before we address the question of flow of capital, we have to take one more step back. What is the source of that capital, right? It is flowing through. Why is it flowing only through Mauritius? And where is this capital originally coming from? And that is more of a governance issue at a macro level, because a lot of these investments are actually happening. It's routed through that channel primarily because there is a corporate wheel available to you, because you don't have to reveal the subsequent sources, you can look at it both ways. From a government perspective, you are agnostic. I don't care as long as money is coming. I don't care where the money is coming from. So therefore, it is good to have such places where you can have, good to have tax havens, because that will become the home to such investments. It's a choice that countries are taking, and I completely accept and I agree with that. I mean, that's the state of, that's how it is currently. And countries also recognize that. It's not that, I'm not painting a good or bad kind of a picture here. I'm just trying to state one part of the story. That's true.
Sure. Yeah. Thanks.
I have a question.
Yeah.
See, when it is such an open secret that big companies are taking all the measures to show less profit and send their money to tax haven countries, then why do the governments not take sufficient measures to check it? It has become such a common practice and it is causing so much of financial loss, then what measures are being taken to check it?
So, it's in fact, it's so open that we can't even call it a secret anymore, right? Everyone knows about it. And the interesting issue is there of, also equity among companies. Not every company can do this, right? As an individual, I cannot do it. I also want to pay less tax, let's say. I cannot do this unless I have to incorporate, it's a huge cost involved. There is a setup cost, right? Which a company like Apple or, some of the large companies can do it. And in fact, Apple went ahead and, signed a special tax agreement with the government of Ireland. So the government of Ireland created special tax structure exclusively for Apple to operate, right? So, this is, now the question that you're asking is, why is government not doing anything? I mean, actually, a lot of things are happening. It's a kind of a cat and mouse chase. In the US, there is a Congress-appointed subcommittee which is exclusively looking at companies. There was a hearing which happened like a couple of years back where, all the top CEOs, Tim Cook and Facebook CEOs, all of them, in fact, including Google CEOs, were there, and they were sort of interrogated, investigated. The concerted effort which is happening at the intergovernment level is primarily led by OECD organization, and under the G20 umbrella. Now there is something called a BEPS framework, right? Base erosion profit.
Yes.
India is also a partnering country in that, and not just double tax avoidance treaties. Some of the questions, some of the issues that I just brought out in the presentation, they have taken that into account in creating both better governance structures within the company, right? Which would be, let's say, as an independent director, I would be interested to ask, why is this structure there, right? So if I create one more mandatory sort of form to fill up, where the independent director sort of, whoever is in the finance subcommittee will have to, sign it off. It again builds one more layer of corporate governance check on this practice. At an intergovernment level, multiple things are happening, including sharing of data. That is one major thing. A lot of sharing of data is now, people are trying to standardize mechanisms to share information with countries. Yeah. So that's a very short answer, but
yeah, no. Thank you. That was a very nice answer. Thank you very much.
So, but the point which we wanted to make was, I'm sure, because Mauritius and India has a great relationship. Now, recently there was an article about Narayan Murthy's daughter, saving money routing through Mauritius. Isn't there a direct dialogue between Indian government and Mauritius government stopping the box companies, So is there any dialogue happening that way? Or because I don't see OECD and G20 for these reasons. We have traditional relationship, and if that's happening continuously, then maybe we can take that.
So good for asking this question. I agree, especially with countries like Mauritius, where there is a historic bilateral relationship between India and Mauritius. And like someone said, it's actually a give and take. It's not a black and white story. In fact, Mauritius is also strategically located in the in that region, and the Mauritius as a country has benefited because of its unique positioning. Capital comes in, part of it sort of gets absorbed in their economy, so they are benefiting from the unique position they are in, and it is in their best interest. If you look at it, it is in their best interest to potentially support some of these facilities in inflow of capital and things like that. From an Indian there are multiple other factors. In fact, some of the ones which I am aware of is issues of geopolitical, strategic issues. It's an important sort of naval base and things like that. So those things take
Sugatan, I have a question.
I have a question.
I have a question, Professor Sugatan. This is Jairaj from Bangalore. May I ask my question?
Yes, please. Yeah.
Yes, sir. Please go ahead.
So my question is that in terms of profit diversion, it moves from high tax to low tax country environments. That's what we saw. So what would be your specific policy suggestions for India, for instance, in order to avoid this kind of tax diversion?
Yeah. So it's a good question. Thank you. And if you see, one of the suggestions we said, you tweak your tax rates.
Okay.
The question is like, it's like saying that there is only so much you can tax without incentivizing companies to go out. And it depends on the quality of your institutions. If you have very good institutions, right, which can sort of track capital, you have deep capital markets, good legal structure, good enforcement agencies, then the costs are so high that you can continue to charge a higher tax rate. But if your institutions are not good enough, then the only option is that you optimize on your tax rates. So there is an optimal sort of balance between how good your institutions are versus what is the
yeah. A quick follow-up, Professor Sugatan.
Yes.
Is there a kind of an organic link between profit diversion and money laundering?
In fact, money laundering, it's the other side of it. Whatever I discussed was completely legal. It's only through transfer pricing mechanism and debt transfers companies are doing it. You won't find anything illegal in whatever they are doing. Everything is a proper legal mechanism. But since you bought it, let's say somebody is laundering money through their, whatever gray operations they have done. How will I sort of launder it? How do I make it? How do I make dirty money to clean money? That's the laundering process, right? How do I clean it up? And that is the point I was referring to in my response to the first question. If investments are coming, why not? The question is, what is the source? Many of these laundered money actually get channelized to safer countries or cleaner countries through some of these mechanisms, and that is also and that is a more concerning part of existence of tax havens, because once they exist, it is a good channel for investment, but it is also a mechanism for all sorts of fund flows. You really cannot control that. It's very difficult.
I have one question. Can I ask a question?
Hello. Yeah.
Yes. Hi.
Hello.
No,
This is the question. May I?
ask you multiple questions. Good to have somebody moderate. I don't know who is.
Yeah, Divanjan, please go ahead.
Okay. Thank you.
Oh, okay. Thank you.
Yes.
I just have a question that is it a practical solution if we know that in the Pan-African economy moving towards a tax haven is a wiser source for getting more revenue? Is it somewhat practical? Because other things have to be considered while reducing tax burdens and framing the revenue statutes to that extent.
Right. And it's a good question, Mr. Banerjee. I mean, it's not a black and white kind of a scenario, right? It's about redistribution of the pie. There is so much pie, and who gets what portion of the pie? That is the question. If I am able to tax higher and take the tax to the exchequer, then that may be utilized for public good. But what happens if I'm not able to tax and the companies are smart enough and they go ahead and save a lot of tax? Where does that money go? Usually it goes to the stakeholders, and what do they do with the money? Usually invest it back, right? In that process. But so it's a very difficult question to answer as to in whose hands the money is more valuable. Right? We are just assuming that in the hands of the government, the money will be best utilized for the greater public good. But that's a contentious question. One can sort of always.
But midway between the two is a dangerous situation.
Yeah.
We neither can become a tax haven nor the present situation. We will lose both ways.
No, we cannot become a tax haven. I mean, there is no way. I mean, given our fiscal deficit and everything else, and the dependence on corporate tax so high, I'm not recommending.
Exactly.
Please don't take that as a recommendation that we should.
Cannot. It's just a hypothesis. Yeah.
I am only saying that there is a potential to rationalize on your taxes, because just by creating this slightly higher taxes, you're incentivizing companies to create all these extra legal bodies, and which is kind of not very effective. And once you create these extra legal structures, it becomes a conduit for many other kind of laws. Not just taxes. Thank you, Mr. Banerjee.
Okay. Thanks.
Okay. Any more questions?
Yes, Dr. Issa. Can I ask a question? Can I ask a question?
Yeah. Who is there?
Sorry. My Beg, Mirza Ghulam Muhammad Beg.
Yeah, Mrs. Hub, please go ahead.
Thank you, Dr. Anish. It was very enlightening to hear you talk, and also from you. When you're talking about rationalizing, I think this also answers Mr. Jairaj's question that he raised. I mean, we are talking about a solution to this kind of anomaly. So, in the process of rationalizing the tax structures universally, can there be a concept of a base rate beyond beneath which no country can go? So the competition is cut there.
Yeah, I think it's you're talking about. I mean, it's a very interesting idea, but it's actually a collective action game theory dilemma. It's something like a collusion of the OPEC collusion.
Exactly.
If everyone agrees to keep the oil prices high, everyone benefits, right? But it's an unstable equilibrium, because everyone has a slight incentive to sort of reduce and get more of the markets for themselves. So it's the same sort of prisoner's dilemma problem. If all countries come together and say 30%, everyone,
exactly,
right?
Exactly.
Everyone benefits as a country. The exchequer benefits, but every single one would be in their mind privately thinking, "यार 30 का थोड़ा सा कम करके 29 कर लेते हैं," and then there is a competition. So the dominant sort of strategy for companies in this kind of a scenario is to reduce, and very difficult to.
Yeah, but it's a takeoff point, in this discussion, such discussions, I mean.
Absolutely. Yeah. Thank you for asking.
Thank you. Thank you.
This is Arun here. I have a question. When is How Kong being rated on heritage?
I'm sorry, Mr. Arun, your voice is breaking actually.
Hello. Yeah, I am Mr. Suryavanshi from Pune. Hello.
Hi, Suryavanshi.
Yeah, it is a very nice discussion on the topic, but we want to know what is the liability of the independent director on this issue. What is the role and how independent director can tackle this issue? Can you elaborate?
That's an interesting question, and I think I would refer back to the liabilities of the directors, in the Companies Act that we have. If some transactions are structured with your knowledge and you know that they are not legal, then I guess you are liable. But then, as I said, most of these structures are completely legal, right? So as long as this is legally compliant an activity, the independent directors, I don't see them sort of becoming directly liable. But if you see, and which comes with your cognizance in the board, if a decision is or a discussion about creating a structure, you should definitely it is in the good spirit of corporate governance as an independent director. You should first of all make a note that this is an instance of tax avoidance, and it has to be sort of noted down. But it's not illegal. If it is not illegal, you're not liable. But by noting it down, you are sort of clearly adhering to the spirit of good governance, and that is what I think independent directors should do.
Thank you.
Thank you, Mr. Vijay.
Sir, I have one request. Hello, I'm Sonal Yagwad here.
Hello, Mr.
What do you expect in the next 5 years if the income tax rate is reduced to 25%? What do you expect?
Well, there could be. I mean, see, this is not a. Tax rates are actually multi-dimensionally computed. There is no one single factor which is used for computing, and the domestic, fiscal budget requirements actually takes over all other dimensions, right? This 25% is actually a result of, if let's say you want to avoid this, but that may not be the number one priority for the Ministry of Corporate Affairs. You work closely with the Ministry of Finance, setting the budget and looking at that will take precedence. That will definitely take precedence. And once you do the calculations, maybe 25% is not good enough. Maybe you need to increase that. So this talk only covers one part of the calculation. Let's say other things don't matter at all. We are a very rich country, sufficiently flush with cash. Only concern is profit shifting. Then 25% matters. Otherwise, 25% it goes in somewhere as a secondary, tertiary consideration.
Yes, thank you very much, and you are giving a good aspect of the trade business. Thank you.
Thank you so much.
Good evening, Mr.
Good evening.
Can I ask?
Sure, please.
Yeah, this you have said is legally acceptable. There is actually nothing illegal about it. And as you also mentioned, that many times it acts different to the home country's shareholders because the profit is flying out of the country. And invariably it is done primarily by the majority of shareholders, and diffused shareholders are the victims of a particular boom. Don't you think there is a need for a regulator or a government to ensure that the minority shareholders are protected? Don't you think we need to do something about it other than the macro parameters? Don't you think the regulator has a primary responsibility to take care of the minority shareholders? Because public interest directors can note it, everybody can record it, but if there is nothing illegal about it, it cannot be denied. So how do we take care of the minority shareholders' rights? Yeah. Thank you.
Thank you, Shanti. This is actually the crux of the corporate governance angle to profit shifting is minority shareholder rights, right? Which is the diffused minority shareholders. So what can we do about it? If you ask me, a lot of it is taken care by the market forces themselves. For example, if the capital market is deep enough, if it is broad enough, then as an investor, I have an option. Say, for example, if I invest in Maruti shares, right, and if I look at the P&L records, I will see that there is a substantial royalty amount that is being paid to Suzuki of Japan, right? I mean, rightfully, I would be happy to have that in my dividends or my own share value. Now, it is extremely difficult, and I feel this has to be, I should also sound a word of caution that capital markets operate when there is a sufficient degree of slack and flexibility for companies to operate, right? If the regulator starts coming up with rules and checks and balances for every small thing, you will choke. I mean, the whole system would come to a standstill. There has to be sufficient slack for the free market to basically operate. And when it comes to this, definitely creates a minority shareholder rights issue. Completely agree with you. But the right way to sort of deal with is, rather than taking a a stick approach, I would say a more holistic approach of awareness. Second, more transparency and declaration from the company. If more information is out there about royalties, if it's explicitly put out, then the investors can make a informed choice. And as a minority investors, I will then compare apples to apples. So my recommendation would be.
Yeah, I think it really.
Yeah. So my recommendation, if you ask personally, would be to increase disclosure and transparency. That would automatically kick in the minority shareholders to follow the market forces, and they will make the right choices. And in a country like India, because now the capital market is deep enough, it is wide enough, it gives options for you to sort of move around.
And I think in addition to that, anyway there is sufficient profit, especially in companies like Maruti. So the need to make an issue out of flight of profits is also not raised by minority in such a way. I suppose at the cost of the minority shareholders, if there is a profit flying, then I suppose it will become a big issue. Right now, I think everybody is happy with whatever they're getting, so minority shareholders are also not making a big issue out of that. Thank you, Professor. It's been a wonderful session. I have been extremely.
Thank you so much.
Mr. Subramanian, Mr. J. Subramanian, I could see a hand raised by you. Do you have a question?
Yeah, I do have. Thank you, sir. Professor Anish, it was a very wonderful session. Just a quick question for you. How do you see in the last about 5 or 10 years the structure in India has evolved to some extent address what you have actually found in terms of the profit being shifted? Do you think that we are in the right direction to somewhere create such an ecosystem in the country that this could possibly be not completely reduced, but at least to some extent arrested in terms of the governance structure which we are trying to create? Are we in the right direction? What exactly would you like to say? Have you done some studies on that?
Yes, I mean, this study, since 2015 onwards, I would say 2013 onwards, there has been a lot of discussions at an international level. And in the last 2-3 years, or the last 4 years, the major sort of development that has happened is how this has come out in the public domain, in the West especially. And that has happened because of the involvement of large companies. Companies which are like otherwise well-known household names like Apple, Microsoft, Starbucks in UK, they paid pretty much zero taxes on millions of dollars of sales. So all of that has been brought out in the public domain. The US Congress has set up a subcommittee for investigating some of these big stars in the tech industry. All that has led to greater awareness among investors about their own rights. In India too, I believe Panama paper leak was one such instance. But we, as an ordinary investor, I would think of it as something which has to concern only with celebrities and their and their private investments. It has a larger repercussion in terms of general minority shareholders in general. The right direction, I would say, what has happened is one, the greater collaborations that India has developed with other countries under the BEPS kind of an agreement, and also double taxation avoidance agreements, which has always been there. But under the BEPS umbrella, we've gotten into, we are a partner country, India is a partner country, and we have kind of developed sort of a global kind of a consortium of countries who are willing to share information. And that's something very critical. And also to come up with consensus standards when it comes to how do you recognize, let's say, transfer pricing, right? So now there are sort of guidelines and standards that are evolving around that, and all this kind of improves the functioning of the capital market, I would say, and it's good to see that we are also going in the same direction, and I feel so. I would go back and say, I don't really want to paint a black and white picture that this is evil, this is good. No, I mean this is it's a part of the way in which ecosystem evolves. It's a matter of setting the right rules, right? And I think we are kind of getting there. We are sort of slowly improving upon the rules of the game so that everybody plays fair. I mean that's the underlying idea. Create the rules of the game so that everybody gets to play fair and nobody gets an edge. So the current system gives edge to large companies which are multinationals. So that's something which is happening. Yeah.
Thank you. And it's really.
Thank you. I could see one more question, and this is going to be the last, I think. Ms. Himani, do you have a question? Ms. Himani? I think she's not. Ms. Himani, okay. Yeah, please. Madam, please go ahead.
I don't have a question. I was
Okay. I could see your raised hand. Mr. Nariman, do you have a question?
Yes, I do.
Please go ahead, sir.
Thank you. Professor, the question I had was there seems to be as a kind of an inbuilt safety mechanism, as it were, for a company to sort of develop and progress further, in the sense that one of the parameters in which its performance would be judged by investors to trade in the shares is to see how much of the profits it plows back into the business in a particular year.
That's right.
And if the company does this, then obviously it has the propensity to sort of grow. And if it grows, obviously the profit grows with it. So don't you think that there is also an element of consideration the company would give to that, especially from the names in which you flashed in your slide? I'm sure this would weigh heavily on the board itself to do this plowback as opposed to profit moving.
Yeah. I mean, in fact, all the companies which I mentioned, they plow it back. Almost all of that is either plowed back or it is, kept as reserve income or accrued income on different books, so that for a rainy day or for some big investments,
right.
we do this. So only question is, I mean, the way they recognize the income and the way it is sort of plowed back. The exchequer as a stakeholder loses out on their share. So that is a concern, And for companies like Apple, for instance, I was actually listening to the inquiry of the U.S. Congress subcommittee in which Tim Cook was being questioned, and one point which they kept on sort of mentioning is that the company Apple, for example. The entire intellectual property that exists is actually built on top of a lot of investments from the public sector, like a lot of open source software. A lot of universities have created this intellectual property, which is publicly funded, publicly available, and they have created these solutions on top of that. And so they have to some way, when they pay their taxes, they are paying back, funding back the public institutions which are generating this. Right, and when they are refusing to do so, I mean that part is cut off. So both these angles are important in this analysis, and that is what I kind of found it interesting with profit shifting. It's not very straightforward, both from a shareholder's perspective. If I'm a dominant shareholder, I'm quite happy that this is happening because it's plowing back, paying less taxes. My wealth is increasing. But if you ask an exchequer, a regulator, they are not very happy because in the home country, because I am losing taxes.
That's right.
Yeah, but if I talk to a host country, they are happy. They are getting a part of the pie. So it's a complex set. But then the idea is if you could make it a little bit more fair in terms of a level playing field.
Absolutely. Thank you, Professor.
Thank you, Mr. Naveen.
I think we have come to an end of this. Just one, Professor Sugathan, if you allow me, just one point I would like to have your perspectives on, profit shifting, like as you have very rightly said, at times it is, not at times, many occasions it is owner's envy and neighbor's pride, So, and this is something which had been a moot point of debate across various global economic forums, it be World Economic Forum or various forums of IMF or even OECD, in terms of as to how globally the corporate tax harmonizations could be attained. Of course, not through a minimum benchmark level or a cutoff, or maybe there were other solutions which had been discussed oftentimes, and over a period of time we have seen a major shift towards that reduction in corporate taxes and levying more taxes on consumption, probably. And this is how the problem has been tried to be addressed, of course, in addition to stricter enforcements and moral suasion, ethical issues, and so on and so forth. So what do you see, like 10 years from now, do economies look like moving more towards consumption-oriented taxation and less taxing on the corporate profits? Or how do you see the future in this direction? I think with this we would close.
Thank you, thank you, Dr. Gupta, for asking this interesting question. And I think it's currently, I heard this debate about, for example, the direct versus indirect taxes question. If I may sort of rephrase this thing, should we be taxed on consumption predominantly and less on income, or the other way around? What is the right balance, and where are we heading as a country? So it's kind of if I ask as a person with for enforcement, right? As an enforcement agency, let's say I want to design this system. It seems relatively easier for me to go ahead and implement taxing the consumption for the exchequer's benefit, because one, it is actually taxed at the point of sales, and the companies which most, especially in the organized sector or the companies that they operate, they have to necessarily file their taxes, and they are under greater or more stringent compliance requirements, and which they already do. The infrastructure already exists. So I am tempted to do that if I were to do this and say, it's a more complex enforcement problem to go out after every source of income and tax it, rather than going after every source of consumption. But having said that, it also has a issue of sort of it's more of a question of stimulation of economic economic activity itself. A lot of in fact, a large fraction of our economy operates in the gray market, right? And we've known from the challenges that we have faced in the rollout of the GST regime, it's not very easy to even enforce consumption-based taxation. People would continue to kind of evade there also. So it's a difficult question. And I guess going forward, I don't see a big shift happening anytime soon, unless one side gets a better institutional sort of enforcement system coming up in place. This I always think, like when I have two children, right? And as a parent, when often I have to referee their fights. And it's very difficult to, and many of you may be parents, you would have, refereed fights of children. it's very difficult as a parent, as a third party, when you go and talk to them to find out who has done right and who has done wrong, and who owns whom what. It's a complex information problem, asymmetry problem as a parent, right? But what you can do is to instill somebody said moral suasion, instill a set of values in the both the kids, and second, create a set of fair rules of the game, which both parties agree to follow. In fact, in game theory, this problem is called a mechanism design problem. How do you create the the technical term is called dominant strategy is incentive compatible, which means that every private party, their best interest, right? When they act in their best interest, the overall social good is kind of maximized. So the challenge going forward would be to create rules of the game which are DSIC or dominant strategy of individual players are also incentive compatible. High tax rates are not DSIC strategies. So it's a complex question. I won't pretend that I know anything about it, because I really don't know which direction, consumption based or income based. I'm just trying to articulate that both have this plus and minuses. But in general, better governance systems, better designed governance systems is what we should be going forward to, looking forward to. Really winded answer to that question, but anyways, yeah. Thank you.
Thank you so much.
Thank you.
Professor Anish, it was an interesting, and definitely it's very tough to foresee the future, especially as you have given a very beautiful point, considering India as a country having a dominance of, there are multiple challenges to it, organized sector versus unorganized sector, because every country has some or the other unique challenges for, recording a transaction and placing the exchequer onto it. And definitely it is not just this factor which will be important for us to decide as to how we as a country would move. Of course, we will have to move with the global trends in terms of our alignment with the global investments and market-based opportunities, but yet we also will have to balance in terms of our own challenges, and that's how the policy makers almost all the time struggle with, because they have to ensure the interest of the nation, yet have to ensure the interest of the larger public. So definitely it's the time which will unfold the answers to these challenges. But it was really very insightful hearing about research, and I could personally and my colleagues at IICA along with the participants could understand the kind of labor you have put in having all this data in place, and a first ever research on this aspect, which was really delightful to hear. So thank you so much on behalf of the institution and the entire group present over here for sharing your insights. And I'm sure in future also we would be happy to hear from you as a public policy expert in the area of corporate governance. And for the benefit of participants, I would like to share that JSW has instituted a Center for Public Policy at IIM Ahmedabad, to which Professor Anish Sugatan chairs. So he has a lot in terms of insights where we could really learn as to how to engage with these processes in the board, so that the country at large and the stakeholders, no matter everybody cannot be a majority shareholder or a powerful shareholder, can benefit. So thank you once again for joining us, Professor Sugatan, and thank you to all of you for sparing your time in your busy evening schedules. and for attending this Power Talk series. I look forward for your participation in the next series. Thank you so much. Have a great evening and stay safe. Bye-bye.
Thank you.
Thank you. Thank you. It has been an honor and a pleasure. Thank you so much. Thank you, everyone. Thank you. Bye.